Right now, major asset classes are pushing new all-time highs. Stocks, gold, and foreign markets are rallying, while one asset has dropped 40%, Bitcoin. Retail panic has set in, and mainstream media outlets have resumed running headlines that the asset has failed. Historically, these clusters of negative sentiment have appeared immediately before the cyclical price recoveries seen in 2018 and 2022. Institutional capital moves based on internal mechanical requirements. These trillions of dollars follow a systematic logic rooted in risk management, rather than reacting to headlines. Capital allocation is governed by the risk curve. Professional money managers operate on a specific mandate. They take only the exact amount of risk required to exceed inflation and successfully hit their performance targets. We map risk on a volatility continuum. Safe cash and T-bills carry 0.5%. The S&P 500 carries 16. AI sits at 52, while Bitcoin hits 75. Thus, institutional liquidity shifted from Bitcoin to AI, capturing returns while reducing risk. This shift is supported by an environment of positive real yields. With inflation at roughly 3.8% and safe U.S. Treasuries also paying 3.8%, institutions can park capital safely and still preserve their purchasing power. However, Congressional Budget Office projections show federal interest payments climbing at an accelerating rate over the next decade, consuming an increasing share of national revenue. To understand this weight, these annual interest payments are now on track to exceed the entire budget of the United States Defense Department. When debt service reaches this level, the federal government cannot sustain high interest rates without risking total insolvency. To manage the burden, the Federal Reserve must eventually reduce yields below the rate of inflation, creating an era of negative real yields. Bitcoin operates on 4-year cycles tied to halvings, programmatic events that cut the new supply of coins in half, creating a recurring supply shock. We are currently in the standard consolidation phase that follows a halving, which is being prolonged by today's high interest rates. Once the Fed reduces yields and safe assets begin losing value to inflation, capital will move back out the risk curve. This shift is expected to trigger a broad institutional move into Bitcoin as the market reaches the anticipated peak of the supply shock cycle in 2026. Our firm tracks specific macroeconomic conditions to identify the exact transition points for this capital rotation. The primary metric we monitor is the spread between the U.S. 10-year Treasury yield and core CPI. We are watching for the moment that this delta crosses into negative territory. We are also watching for the Federal Reserve to begin lowering the cost of capital, while monitoring the AI sector for signs of institutional profit-taking as valuations reach their limits. We are preparing capital to capture the expansionary phase of the 4-year cycle, targeting 2026. Your capital is positioned for the current requirements of this cycle. When the real yield delta shifts, the strategy is in place to execute the next phase of allocation.